Thank you. Good evening, everyone. I welcome all the participants to the first quarter 2019 earnings conference call of Rain Industries Limited. Speakers on today's call are Jagan Reddy Nellar, Vice Chairman of Rain Industries Limited, Gerard Sweeney, President of Rain Carbon Inc., and T. Srinivas Rao, Chief Financial Officer of Rain Industries Limited. During the call, management will be referencing and discussing a slideshow presentation which is available for viewing on our website at www.rain-industries.com in the Investor Relations section. We recommend viewing this presentation while listening to management's discussion. Before we begin, I would like to mention that some of the statements made in today's discussion may be forward-looking in nature that could be affected by certain risks and uncertainties. The company's actual results could differ materially from such forward-looking statements. Now, if you could turn to slide 3, I would request Jagan to provide you an update on key developments within the Rain Group. Over to you, Jagan.
Thank you, Ryan. A very good morning to all of you. Results for the first quarter once again illustrated the resilient nature of Rain. The resiliency of the business has never been more evident than past several quarters as we have endured extreme commodity volatility and absorbed the shock of new regulatory constraints. Referring to slide 3, consistent with the expectations communicated last quarter, although results were down from a year ago, we saw an incremental improvement from the fourth quarter with EBITDA of 3.6 billion rupees, which we believe represented a cyclical trough. In particular, revenues continue to be impacted by weaknesses in our calcination business, where pricing remains soft and volumes reflect weakness in certain end markets and the impact of ongoing pet coke import restrictions in India. For example, global aluminum demand was particularly weak, especially in China, but we continue to view this as temporary. On the cost side, we are working through the older, higher-priced inventory that began to negatively impact margins toward the end of the third quarter of calendar year 18. In addition, actions such as the curtailment of raw material purchases initiated in the fourth quarter, as well as ongoing rationalization of the business and a consolidation and closure of plants that will reduce costs are helping improve efficiency and expand margins. Consequently, EBITDA increased roughly 1.2 billion rupees sequentially from the fourth quarter. And although EBITDA in the first quarter was a little more than half than compared to Q1 2018, we anticipate that a better balance between selling prices and material costs will take effect during the coming quarters, especially sometime during the second quarter. As a result, we expect the EBITDA to improve in the second half of the year. In the carbon business, revenues decreased 6.3% year-over-year. The decrease was primarily due to the pet coke import restrictions and increased price competition in Asia from excess CPC coming out of China as a result of reduced aluminum demand and production in China. In the advanced material business, we began to see a return to more normalized conditions during the first quarter. Raw material costs stabilized and demand increased for key materials such as our resins for Europe's premium tire market and petrores, an engineered product used in specialty applications such as lithium-ion batteries and energy storage. Those improvements were offset by continued weak demand by the Chinese automotive industry and reduced sales volumes for our environmentally friendly carburetor binder as we choose to protect profit margins. We are committed to complete the new water-white resins facility in the coming months. Once commissioned, this plant will become the cornerstone of our advanced material business, and the Novares Pure resins produced at the facility will be part of a portfolio of raw materials that are essential to cleaner, faster, and lighter 21st century applications. Our team is putting determined efforts towards achieving revenue growth and improved margins. Last year, we realigned our product portfolio to put an increased focus on advanced materials. The purpose of the realignment was to carefully evaluate which products, old and new, are best suited to meet the evolving needs of our customers and society. We are very pleased with the progress being achieved to enhance the results of our advanced materials operations and the steps being taken to improve the productivity and cost effectiveness of our manufacturing facilities. With this business update, I will now turn over the call to Jerry to take you through the industry and other business updates on slide 4. Jerry?
Thank you, Jagan, and good evening, everyone. It's a pleasure to speak with you all again. Following the 2017 ramp-up in smelting capacity, 2018 was a year of aluminum oversupply and a corresponding drop in prices. While there is virtually universal agreement that over the long term, demand for aluminum outside of China will increase at a rate of approximately 2 to 3%, a slowdown in China's transportation, packaging, and electrical industries has created a short-term pause in demand growth and a weaker overall pricing environment. Nevertheless, we anticipate a rebound in global aluminum production and a corresponding improvement in CPC and coal tar pitch volumes and pricing as we move toward 2020. As we indicated during our last call, much of the growth is expected to occur in India and the Middle East regions. These are natural and freight logical markets for Rain. We remain very optimistic about this part of our business. Demand for aluminum is expected to increase for the foreseeable future as it continues to gain traction as the metal of choice in a growing number of applications, thanks to its high strength, durability, lightweight, corrosion-resistant, and recyclable nature. As the world's second largest producer of calcined petroleum coke and largest producer of coal tar pitch, both irreplaceable ingredients in the anodes required to produce aluminum, Rain is well positioned to continue its role as a key supplier to this industry. In terms of our carbon distillation business, we believe that we have now moved through the bottom of the cycle for our coal tar-based products, and we see a number of bright spots going forward. For instance, continued softness in the Chinese economy should result in lower coal tar production by China's steel industry. And we are capitalizing on this opportunity with additional shipments of coal tar pitch from our European operations into the Middle East. I'm also pleased to report that we are making significant progress on the construction of our vertical shaft calciner in India and our hydrogenated hydrocarbon resins plant in Germany, both of which are due to be completed during the third quarter of this year. Both these projects will be marginally over budget due to increased material costs on account of changes in technology and some labor costs. Consequently, after investing over $140 million in growth and maintenance CapEx project in 2018, we have committed approximately $150 million this year to complete the vertical shaft calciner and hydrogenated hydrocarbon resins plants, in addition to some other projects. The new plant in India will provide additional capacity to meet the anticipated growth in aluminum demand and will ultimately lower our cost of production in one of our fastest growing geographic markets. The European resins plant will open its doors to new markets in certain high growth areas and bring new life to some of our established products in more traditional industries. Now let's turn to slide 6 on the pet coke importation restrictions in India. We expect that our calcination business will continue to be impacted in the near term by the unresolved issues related to the India pet coke import restrictions. During the last quarter, the Indian Directorate of General Foreign Trade, or DGFT, allocated certain additional GPC import quantities available from surrendered quantities by other calciners. This means that they did not want to import this product. Rain's GPC allocation increased to 554,000 tons for the period April 2019 to March 2020, which allows the existing plant to run at 78% of capacity and began procuring GPC from domestic Indian refineries to further increase capacity utilization potential. Rain is filing a petition to consider the new capacity addition as a separate allocation for Rain and to permit Rain to import CPC again under certain conditions. We are hopeful the court will resolve the issues in the next few months. Beyond the pet coke importation restrictions in India, we are taking aggressive steps, unprecedented steps in the history of Rain, to restore our legacy calcination business to a world-class competitive position. To drive this effort, Jagan Nellore has stepped down as Managing Director of Rain Industries Limited, and the two of us will devote our combined energy to rationalizing our business activities, especially in calcination, so that this business is once again performing at a level we know it can. At the same time, we'll be working together to solve our remaining issues in India and ensure the successful completion of the shaft calciner project. While the petcoke importation restrictions in India and commodity price volatility represent potential headwinds, our underlying business drivers are improving. We are investing for the growth opportunities we see and to strengthen Rain over the long term. So consequently, this will be a year in which we will be balancing our investment and cash generation to effectively manage leverage and liquidity while preparing for what we see as a very bright future. I feel good about the upcoming year. In a highly competitive and rapidly changing world, we are fully committed to doing what's necessary to return our business to profitability so we can continue to create value for our customers, communities, and our shareholders. With that, I will hand the call over to Srinivas, who will take you through the consolidated financial performance of Rain. Srinivas?
Thank you, Jerry. And good evening, everyone. It is a pleasure to speak with you today. In the first quarter of 2019, Rain achieved consolidated revenues of $31.8 billion compared to $32.9 billion in the first quarter of 2019, a decrease of $1.1 billion or 3.4%. This resulted from a decrease in revenue of $1.4 billion or about 6.3% from our carbon business segment and $0.2 billion or about 2% from our advanced material business, offset by $0.5 million or a 20% increase in revenues from our cement business segment. Rain's consolidated adjusted EBITDA decreased by about $3.1 billion compared to the prior year, substantially with a decrease in carbon business by about $3 billion and advanced materials by $0.3 billion, offset by $0.2 billion increase in cement business. As expected, recovery was seen, but the performance of our business continued to be impacted by our high-value inventory compared with lower selling prices, as well as ongoing softness in the global aluminum production, a sluggish Chinese economy, and the petcoke import restrictions in India. Now turning to the next slide on carbon business performance. Revenue from our carbon business segment was $21.3 billion for the quarter ended March 31, 2019, compared to $22.8 billion for the same period last year. During first quarter of 2019, the average blended realizations decreased by about 0.5% after considering the favorable impact from the appreciation of US dollar and euro against Indian rupees by 9.4% and 1.1% respectively. The drop in CPC price was primarily driven by reduced prices in the Asian market and price pressure in North America due to delayed start of smelters. Gross sales volume in carbon business decreased by about 5.9%, mainly due to decrease in CPC volumes by 8.5%, and volumes are other carbon products by 3.6%, and coal tar pitch by about 0.8%. Overall, due to lower volumes across all carbon products and decrease in realization of CPC, the revenue from carbon business segment decreased by 6.3% in March 2019 quarter as compared to last year. The decrease in volumes was partly driven by the timing of the export shipments compared to prior year, reduced demand from titanium dioxide industry, and the import restrictions in India. Turning to next slide on performance of advanced materials. Revenue from our advanced material business segment was $7.7 billion for the quarter ended March 31, 2019 as compared to $7.8 billion for the same quarter last year, a decrease of $0.1 billion or 2%. During March 2019, sales volume increased in petrochemical intermediates by 10.7%, whereas it has decreased in resins by 20.5% and naphthalene derivatives by 3.2%. The sales volume in our engineered products business segment were flat and resins volume were partly down, primarily related to continued weakness in the European automotive industry where most of our resins are being sold there. During first quarter of 2019, the average blended realization increased by 3.7%, along with favorable impact from the appreciation of the euro against the Indian rupee by 1.1%. Price decreases in engineered products were primarily related to our corporate specialty binders. The decrease in price of petroleum intermediates was driven by a reduction in oil-related prices. Naphthalene derivatives average prices were higher due to changes in the customer mix on account of eliminating some lower priced sales, which had little impact on the volume. Resin prices were up due to a better mix of customers. Moving on to the next slide on cement business. During the first quarter of 2019, there was a favorable trend in sales volume in our cement business. There was an increase in volumes in most of our markets such as Andhra Pradesh, Telangana, Tamil Nadu, Karnataka, Maharashtra and Pondicherry, partially offset by decrease in volumes in Odisha, Kerala and Goa. Overall, our increase in volumes by about 19.9% and sales realization by about 0.1% during March 2019 as compared to last year. Due to these reasons, the revenue from cement business increased by about 20% and EBITDA from cement segment has increased by about 0.2 billion rupees. We are working towards reducing costs by various efforts, the largest of which was the installation of waste heat recovery power plant at our Kannur and Nalgonda facility to enable the plant to produce approximately about 11 megawatt of electricity from the waste gases generated in the manufacturing process. All the electricity produced from the waste heat recovery power plants is consumed in the respective cement plants. In addition to this, we also upgraded a cooler in our Nalgonda at a cost of 156 million rupees to achieve energy efficiency. Further, as discussed in the previous slides, we are undertaking technology upgrade at our Kannur facility to improve the efficiency. On a positive note, we have seen increased demand in the states of Andhra Pradesh, Telangana, Tamil Nadu, Karnataka as compared to previous quarters, and we anticipate this demand continuing throughout the year due to infrastructure and housing projects. Moving to the next slide on the debt position of the group. At the end of the first quarter of 2019, our gross debt was $1,098 million US, which includes $47 million of working capital debt. We incurred capital expenditure of 2.5 million rupees or around 35 million during the first quarter of 2019, which includes about $19.3 million spent on our two major expansion projects under construction, the HHCR project in Germany and a vertical shaft calciner project in India, apart from the expenditure on other expansion projects. Net cash in financing activity is about 2.1 billion during 2019, which includes 1.8 billion rupees of net outflows towards repayment of borrowings. Balance 0.3 million is towards interest repayments. The company ended the quarter with a net debt position of $931 million and net leverage ratio of 3.5x based on the LTM March 2019 adjusted EBITDA. With $150 million of cash on the balance sheet and unused credit lines of about $166 million, the company is comfortably placed to meet its debt obligations and continue to make the required investments in the expansion projects. Finally, finance cost during March 2019 is 1.1 billion rupees, a decrease of about 4% compared to 1.2 billion incurred in March 2018 quarter. The amount in March 2018 quarter included a deferred finance cost charges because of refinancing activities completed during that period. Our average borrowing cost stood at 5.3%. We expect the net interest expense to remain stable as the floating rate portion of our long-term debt is tied to the Euribor, which is still negative. With that, I will now turn the call over to the operator to start the Q&A session. Over to the operator.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Arvind Kothari from Niveshaay. Please go ahead.
Good evening. My first question is related to our net debt that we repaid this quarter. I believe our bonds are quoting at less than their, par value. So, what was the strategy of not buying back the bonds and repaying the European debt? That is also a small portion. So, what is our strategy going forward of that? And my second question would be relating to our CPC. We've gone through a few reports that still forecast that the CPC prices are still falling down in the month of April also, and they're hovering around $310 maybe. So how confident we are that our GPC cost would fall commensurately to give us a bit of margin? Because if we look at our numbers, I guess CPC might not have positively contributed in terms of margin this quarter, if I'm not wrong. So going forward, which quarter we expect the CPC to positively contribute to the EBITDA? I would like to understand.
Yeah, Arvind, with regard to your first question on the reduction in the debt, as you could see in the slide that was given on the debt position, substantial part of the debt reduction is only from the working capital loans.
Correct.
We will be borrowing the working capital loans based on the business requirements.
Correct.
We have two major debts. What we have is the term debt, which is in the form of a high yield bond repayable in April of 2025. $550 million, which is a fixed coupon bond. Then we have a euro currency denominated term loan B, which is payable in January 2025.
Right.
There are no scheduled repayments against these the euro currency denominated term loan. No? So whatever debt reduction you have seen is only in the repayment of working capital. And the second part of your question of debt reduction is why we should not use our cash to buy back the bonds. No? As we have two major expansion projects are in pipeline, management do not want to spend any money towards repayment of the debt. After completion of these projects, any excess cash that is generated will be used either for further expansion. If there are no further expansions are planned, that will be used to reduce the debt. But at this time, we are not looking at unless we complete the two expansion projects, neither we will approve any expansion project nor we will repay the debt.
So how much would be the amount that is left to be for these two expansion projects? What amount is still pending for the expense to be done, if I can get an idea?
I think Mr. Jadiswini has already indicated that for the calendar year 2019, we will be spending around $140 to $150 million. Not only these two expansion projects we need to complete, but we also need to complete certain recurring maintenance capex, which is around $60 to $65 million.
Okay.
And the basic recovery plant in the cement business and the modernization of the cement mill also is in pipeline where we need to spend another $5 million.
So how much have we spent in the first quarter of this $150 million?
First quarter, we spent about $19.3 million.
Okay, got it.
Total is about $35 million we spent. Out of that, $19 million is for these two projects and about $16 million for other various miscellaneous projects.
Okay, got it.
Maybe the second question on the prices, Mr. Jadiswini will talk about fall in the CPC prices.
Correct.
Yeah. We've seen, since really the second half of 2018, we've seen consistently falling prices. With this year, with the weakness that we've seen in the aluminum price and also slowdown in aluminum production in China, we've really seen prices fall off from mid-last year, $400 level, into now the $270, $280 range for second quarter of 2019. So with the price collapsing, we're rushing to reset our raw material prices again.
Okay, thank you.
Okay, thank you.
Thank you. We'll move on to the next question. That is on the line of HR Gala from Finvest Advisors. Please go ahead.
Hi, congratulations to the team for giving a resilient performance. Continuing with the earlier question, currently, from the S&P Global players, we understand that CPC prices, some quotes are at even $275, $290, $300. So going ahead, do you really expect that CPC prices could soften to that extent?
Okay.
CPC prices.
CPC prices have softened to that extent.
Yeah, CPC.
So basically, what happens is, once the CPC prices soften, the green coke prices also soften. One more thing is green coke prices more or less are dependent upon CPC prices, but the floor level is somewhere related to the fuel level. Because the other option, instead of using GPC for calcination, the other usage is fuel. So, and now the fuel prices are also kind of weak. So we do expect that...
Can you give an indication as to what is the GPC prices currently prevailing?
Well, the lower quality, the best quality prices are maybe 175, and the cheap qualities are, the lowest qualities are $80 to $100.
Okay. And CPC prices, do you really expect that it will be reduced to so much, about 300 level, as it is reported in Platts?
Yeah, I mean, this is what happens when a market comes off a high. It tends to fall off pretty substantially. It's nothing different than other trends we've seen in past cycles in CPC.
Okay. Now, sir, from this HHR project, which will be commissioned by third quarter, what kind of incremental revenue we can expect over a period of time at optimum capacity utilization?
You're referring to which project?
HHCR.
Yeah, HHR project.
It should generate about
HHR
$150 million.
Hydrocarbon resin, HHR.
Yeah, about 150 million euro, please.
That's the revenue we are expecting?
The revenue, yes.
Yes, when it's in full production.
Okay. So when do you think we can reach that level of revenue?
That I cannot tell you, but we can tell you that it's going to commence operations in third quarter.
Yeah.
And we will try to bring it up as fast as possible, but we cannot give you any dates on when it can reach any particular.
We're only figuring, we've only structured it, and our expectations is ramping up over 3 years.
Okay. And the EBITDA margin in that particular product should be much higher than, what we earned in CY17 in the advanced material of about 17% type. Am I right, sir?
Yes, the profitability of the business should be greatly improved with the HHCR as we replace lower valued and low margin products in our portfolio.
Okay, that is good. Okay. So any other major concerns on the demand side do you think will continue for a while because of the softness in European market, Chinese market, etc.?
I think that's a good question. I mean, we had concern in the second half of last year when we saw a little more wide scattered weakness. We saw the industrial and economic weakness in China, and that seems to have stabilized, and we expect it to get better from here, not worse. We did see weakness in certain sectors in Europe, certainly in the automotive sector, but so far this year that seems to have corrected itself. And then the fourth quarter weakness we had seen with a lot of speculation about the recessionary trend in the U.S. economy has been completely halted and reversed now with very, very strong GDP growth in the U.S. in the first quarter, very strong jobs reports coming out, and, I dare say all except perhaps the tech sector being very strong earnings reports. So we're fairly bullish that things should remain economically strong going through 2019.
Okay, that's good. And last question from my side.
Sorry to interrupt, Mr.
Just last question, please.
So may we request that you return to the question?
Okay, fine.
Waiting for their turn.
Okay.
Thank you. The next question is from the line of Dhruv Muchal from Concall Securities. Please go ahead.
Thank you. Sir, a question on the volumes. Your CPC volumes are down by about 15% and 8% QOQ in 1Q. So what should we look at for the full year? Any guidance on that?
Well, we don't provide forward projections, but what I will say is the clear comparison there is don't forget that with the India petcoke ban, we're not allowed to import CPC from the U.S. into India, which was a major part of our strategy. So that was roughly 250,000 tons a year that we had been moving, that now we're attempting and quite honestly scrambling to place in other places worldwide. So easily that amount of reduction, quarter over quarter is just indicative of the impact of that we have not been able to replace to this point.
Mm-hmm. So you did about 350 KT, 360 KT in 1Q. So should we think 350 to 400 will be our quarterly run rate, assuming the situation does not change on the ban?
Yeah, Dhruv, if you see the year as a whole, we have 1.65 million is what we have done in CY18. Like Mr. Jerry just mentioned, about 250,000 tons is what the U.S. is supplying in India. So 1.4 should be broadly okay.
Yeah, 1.4 is probably the number for 18.
Okay, sure. So secondly, you mentioned that CPC pricing is down to about 270, 280. I see in 1Q it is about, the average pricing is about 350. So that's about $70 decline. How do you see the GPC pricing to that extent? Has it declined, come off to that similar amount, or can we see some margin pressure in the subsequent quarters?
Well, we just talked about where the GPC pricing is. The key for us is pushing out the existing inventories that we have that we're still working off, even we'll be working off in the second quarter. So that's really key for us. We're not terribly concerned about restoring margin beyond that, because with GPC prices anywhere from low grades $80 to $100 and the better grades $170, $175. This really leaves us the opportunity for margin with our blending.
Okay, so broadly the current margins will sustain if once the inventory is out, the high cost inventory is out.
That's how we...
Yeah.
Yeah. So this is the last question. You mentioned the Shaft Calciner project. You are petitioning the Supreme Court. If, for example, it is approved, what could be the volume jump because of this? I think the bigger part will come in CY20. So if you can give the CY20 number.
Well, it depends on demand, but for 20, I think probably the best we could look at with a new setup would be a 50%. 50% in the early stages, ramping up to 80% throughout the year. So I guess you could look at it that way. Early on, we wouldn't push it. We kind of run at 50% and then establishing ourselves probably up the second half of the first operating year to 80%.
Sure. Just to refresh my memory, what is the total capacity here? 370.
370,000 tons, 0.37 million tons.
0.37, sure. Got it. Thank you so much. I'll come back in the queue.
Thank you.
Thank you. We'll move on to the next question. That is on the line of Vikram Sharma from Fulfin Capital. Please go ahead.
Hello. Yes, sir. Who are the major players in hydrogenated hydrocarbon resin?
You are looking at customers or the competitors?
Competitors.
HSCR. BASF, Eastman Kodak, Eastman, and Arakawa. All these companies.
Yeah, competitors in Europe are, as Jagan stated, but there is excess demand in Europe that is currently being imported. So it is a bit of a negative availability market that's being supplied locally from Asia.
And also we will be supplying the material in liquid molten form instead of pellets. So they can directly use the material without actually reheating it.
Okay. And so my second question is, there is possibility of drought again in Rhine River?
See, Rhine River actually last year had a problem, but next year at this point of time, we don't know. But we are actually making, alternative arrangements for the same. And actually, we have our new barge ship, you can call it, which can actually, even at low levels of Rhine also, it can still fly. So,
yeah, the Rhine has been an issue for us. As Jagan mentioned, we've made alternative arrangements to be able to avoid the river, quite honestly, on truck where necessary. But hopefully the Rhine won't be anything prolonged. It usually returns to normal levels, as we move through the middle of the year.
Okay, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Anubhav Sahu from MC Research. Please go ahead.
Hi, sir. A couple of questions. One is, given the import restriction and quota assigned to us in the CPC business, what is the capacity utilization we are looking at for the India business? And also, if you can elaborate on at what capacity utilization we could be running our U.S. plants given the restriction, and if we don't change the business model.
Capacity utilization of our Indian CPC plants.
Well, the capacity utilization from India, we're going to, we're going to seek, and we're targeting 100% capacity utilization on the plant. That is our allocation, as well as buying some domestic product to fill in around it. Outside of India, in the U.S., we do have one plant idle currently, which is representative of the shortfall because we're not exporting to India.
So that plant has a capacity around 150,000. This is what you mentioned, the U.S. plant?
That's 220.
220, okay. And so, given this current context, last call you did mention about changing business model, how to deploy, how to get the U.S. plant get on working and how to deploy those CPC. So is there any traction on that? Are we making some changes on that?
Yeah, I mean, we are. From a model change perspective, I think you're referring to the fact of accepting that for the foreseeable future, we're not going to be able to ship CPC product to India. So we're going back, increasing volumes to our existing customer base, as well as pushing tons into new customers to make up for that. But it's a process. To this point, we've had limited success. We're hopeful of being able to achieve perhaps 50,000-60,000 tons of additional sales within this year. But it's a process. In this business, you don't just change strategies midstream and then expect that you're going to be able to, especially in a falling demand environment, expect that you're going to be able to have great success.
Got it, sir. So your presentation mentioned that the alternatives of calcinous in India is to find alternative raw material sources and also methods to lengthen imported raw material volume. Can you please elaborate? What are those sources and methods probably we'll be looking at, and probably this is why we are still targeting 100% utilization for India business?
Yeah, there are both low sulfur and high sulfur opportunities to source in India. And so we're looking at that, and the experience we have with our ICE technology allows us to employ some methods that are not necessarily standard for the use of shot coke in the calcination process. So, there are cokes available within India that are helping us to supplement the allocation that we have from the DGFT for the year.
Okay, got it, sir. Got it. Thanks for taking my question. Thanks a lot.
Thanks for your questions.
Thank you. The next question is from the line of Kalpesh Koti from Valentis Advisors. Please go ahead.
Yeah, good evening, sir. Most of my question has been answered. Two questions, sir. You spoke about the high cost of inventory. How much is there in the books now?
We expect the high cost inventory to be over in this quarter, please, the current quarter.
Okay. Yeah, thanks. And one more question, sir. You spoke about just, HSR have a excess demand in Europe, which is met by the imports. So can you quantify how much in terms of volume?
No, we cannot say that, but they do import from China and other places actually. But there is a shortage of HSR products in Europe.
From the importing the resins, I would say our best estimate would be in the neighborhood of about 10,000. The market itself is deficient by about 10,000 tons as it stands today.
Okay. Thanks, sir.
Thank you. The next question is on the line of Runjhun Kabra from Nivshay. Please go ahead.
So I wanted to get a sense on the Indian CPC scenario after the after the import cap quota. So from the industry reports, I understand that there is a Chinese CPC prices are declining. So is there any competitive pressure that we face? Like, is there any competitive pressure that we face, and how is this import quota thing panned out? Are we able to run the operations before smoothly? What is the scenario right now?
Yeah. The Chinese CPC situation is, in natural to any market scenario. When your domestic market is not pulling enough demand from you, you're going to seek export opportunity, and that's taking place in China. They led the market up when demand was very strong in China, and they're leading the market down now. We believe that we're beginning to see the bottom of pricing in China because their raw material prices have stopped declining, and actually some of them are inching up. We'll be watching it very carefully over the coming month to see how that continues. But there's no doubt that the Chinese work on more slim margins than we do, paying more for their GPC product, and as such, they'll be very sensitive to the balance between GPC and CPC price.
Okay. Platts have actually highlighted in the report that Rain has idled its Louisiana refining capacity. So is that true, or is it temporary because of we are not able to source CPC for the blending facility? And what is the status that of the US restarts that we can get incremental volumes from there? And
see, at this point of time, we are not able to import CPC for blending purpose in India because of the restrictions by the Supreme Court order. But otherwise, the domestically produced with CPC, we should be able to maintain the previous year volumes, whatever we have delivered.
And how much, what is the status of the restarts of the U.S. smelters that we can expect in the next quarter? I mean, in the next half year?
We're still seeing, albeit slow, we are still seeing restarts and in the U.S. That's actually helped us to pick up some additional volume in North America to help replace the fall off in our ability to ship to India. But we are still seeing U.S. capacity come back online and ramp up, although it has been much slower than originally anticipated.
Okay, thank you so much.
Thank you.
Thank you.
The next question is from the line of Akhilesh Kumar from Agro Technologies. Please go ahead.
Yes. Thank you, and good evening to everybody. Jerry, I have a question regarding the same scenario of because of China, what we are seeing, the pressure on the CPC. I understand that in U.S. we have 10% tariff on Chinese imports of carbon materials, including CPC and CTP. And the plan is right now that to increase it to 25% from coming Friday. How do you see that will help in the pricing?
We don't import GPC actually from China, and even US smelters also are not importing any GPC from China, CPC from China. So that should not either impact this increased tariff should not impact us or the smelters.
Yeah, there's nothing in our CPC system that is impacted by any current existing or contemplated tariff action.
Okay, I think I got it differently. What I'm asking is, US is putting a tariff on the Chinese imports in US. So in that case, you should not be anticipating that Chinese import into the US will be reduced because of the tariff put onto them?
Yeah, but there's very little to no import of CPC into the US anyway at this point. So that's not really an issue. That doesn't give us an advantage.
The U.S. is a large net exporter, which is a very large producer of calcium petroleum coke. So there's no reason for China to come and compete, and I don't think they'll be able to compete also.
Okay, and one more question. Recently, there was another company, Goa Carbon, has given a scenario where it says that Indian smelters are trying to import as much they can from their 50,000 quota from China, that lower price CPC. That's why the demands from Indian smelters are very less. And subsequent quarters, it might increase once they exhaust their entire quota of imports. How do you see that pan out?
See, aluminum smelters in India might be are capped to import only up to 500,000 tons of CPC. They cannot import anything beyond that.
Okay. So would that impact the prices in the later quarters when they won't be able to import and only the Indian CPC producers like us will be the only place where they can buy it?
See, actually, the limits that are set up by the Supreme Court, the 1.4 million tons of GPC and 0.5 million tons of CPC, was based on the actual imports for last 2 or 3 years. No? So, barring the new expansions, it should meet the requirements, and maybe the courts might review the position in the future.
Okay. Thank you. And one last thing, if I can ask, like for the new expansion vertical shaft project from Vizag, for this year import quota has been already closed. So when we want to, we expect to apply for that imports of GPC for that plant?
See, we expect actually, we are in discussion with the authorities that there is an error in the allocation this year. So we expect, to challenge the quotas. So we do expect the new plant also to be given some additional allocation, probably after the court holidays, vacations.
Okay, great. Thanks a lot.
Thank you.
Thank you.
The next question is from the line of Dhruv Muchal from Motilal Oswal Securities. Please go ahead.
Yeah, thank you. Can you just reiterate the capex number? I understand 150 million is for projects. What is the total overall capex for CY19 and some color for CY22 if you can?
150 million includes the maintenance capex as well as the expansion capex.
Okay, so this is the full capex for CY19. There's nothing to add here. Okay. And just some understanding on the U.S. volumes which we are losing because of India. Now, if I understand correctly, this volume loss is only because the market is weak. If, for instance, aluminum improves, you will be able to place these volumes somewhere in the world. It is just the weakness in the market which is avoiding this, which is causing this volume loss. Is that right? Or is it because the grade is something else and you'll have to find that particular kind of user for this grade?
No, it is both the petcoke restrictions by the Supreme Court as well as the weak demand. Both are contributing for the loss of volumes for the U.S. plants. But some of the volumes we should be able to gain when the U.S. smelters restart their operations in U.S.
No, so my point was, overall the market was already relatively balanced. Now, if you're losing volumes from India, you are selling the CPC volumes from India, and some customers was buying from you. Now, if these volumes are not available from India, that customer will have to buy it from somewhere else. So probably, why can't you supply it directly from US market? So is it the grade is different?
At the same time, the Chinese market is softening because of the low aluminum production increase there. Because of that, whatever shortfall from rain volumes is there, that is taken care from the CPC exports from China into India.
Yeah. What you're missing there is that we used to bring CPC over that was an optimal production of low-cost CPC from the U.S. in order to be blended here in India. Then we were able to make a complementary blend here in India that combined made the most cost-effective product that we could sell on. When you eliminate that ability to import and we just have to supply directly to the customer, we lose that competitive advantage that we have. And now we're just going straight up against the availability from China, which is closer from a freight perspective. So on apples to apples, we're at a disadvantage because of the inability to import CPC.
Okay. So to understand it further correctly, so if U.S. Smelter market had to recover, the U.S. aluminum production had to increase, then you will be able to sell these volumes. Of course, not all the volume, but a decent portion of it.
Yes. If it increases substantially enough that we can place all the volume, yes, that would be true.
Because then the freight cost disadvantage will no longer be there.
That's right. Obviously, we're freight advantaged in the U.S.
Yeah, freight advantage. Yeah. Got it. Thank you. Thanks a lot.
Okay.
Thank you. The next question is from the line of Abhishek Kumar, an individual investor. Please go ahead.
Thank you, management, for having a wonderful question for all of us. My question is more related to the strategic problem that the team is going to face in coming years. Alcoa and Rio Tinto has formed a joint venture with Canadian government to set up carbon-free anode production. That would give have material impact on the business model of the company and how the company is trying to cope up with that, because if things come to that level, by 2024, lot many existing aluminum players will probably shift to the new technology. Is this a material impact to the business model, or the company is considering it as more of an R&D effort at this point of time?
I'll be as frank as I possibly can be on this. The inert anode technology, which they've now termed ELYSIS, is not a new technology. It's been around for the last 20 years. It's not proven to be economically viable from a cost perspective. If you look at the announcements related to this, it's a very positive PR effort to talk about environmental responsibility in the production of aluminum and trying to go to an inert anode type of technology. The interesting aspect of this is that if it were truly a breakthrough technology, you wouldn't see anybody sharing it with anybody else. While you have two aluminum majors sharing it, and the lion's share of the investment in the R&D on it is coming from the governments, not from the companies themselves. With that said, I do believe that they're moving forward with this, and they're trying to make it as commercially viable as they can in using it. And, for companies in the future that will say, look, we'll pay more for more environmentally friendly technologies, which we're hearing a lot about, is, someone that would be interested in that is someone who's a technology partner in this, like Apple, with the iPhone, for the 200,000 to 300,000 tons of aluminum they use a year in producing, iPhones, iPads, and such. There may be a scenario that if they can get it cost competitive enough, that this would be something that they'd entertain to pay more for that aluminum in order to be able to say, we've achieved this. As you know, Apple's been under a lot of scrutiny to make sure that they are doing environmentally friendly things in the production of their products. That's been fairly public. So with that said, our feeling is that rather than this being something that truly threatens the viability of carbon in the aluminum reduction process. This is something that will be a small niche boutique industry going forward, but that the current process under which aluminum is made will still be what 95-98% of aluminum will be made from worldwide. We think that if you just look at the annual growth of aluminum production, that it far outstrips any threat that ELYSIS technology or inert anode technology presents, certainly over the next 5 years.
That's comforting, actually. But so it's good that management is keeping a track of it in the sense that it's just that based on the premise that if the value is moving towards some other portion in terms of business model, our management is equally oriented towards moving to that piece. And then that way I hope that the management is doing really a good job. Thank you.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Jagan Mohan Reddy for his closing comments.
Thank you. After a turbulent 2018, we are beginning to see a return of costs, pricing, and profitability to levels that most observers of our business would consider normal. Although I believe it will take another quarter or two to get back to the position where we are again generating normal EBITDA, there are a number of signs that things are moving in the right direction. Among them, the flushing out of high-priced inventory from our carbon and advanced material businesses, a gradual return to traditional spreads between raw material costs and selling prices, increasing global demand for aluminium and carbon-based raw materials that make 21st century products and applications possible, reduced interest expense thanks to last year's refinancing, and strong liquidity. When you look at our projected CapEx spending and tax and interest expense for 2019, you may well conclude that this will be a cash-neutral year for Rain. It is important to understand, however, that we will have maintained a cash-neutral position despite significant capital expenditures on our HHCR and shaft calciner projects, and a reduction of the outstanding balance of working capital from our internal cash flows. We are also taking the necessary and appropriate steps to secure the long-term strength and profitability of our company. In addition to producing the raw materials that make so many products that people rely on possible, the 2,600 employees of Rain have dedicated 2019 to completing major capital projects, rationalizing our production and logistics networks, and updating our product offerings so that we are well positioned to drive future growth, create shareholder value, and ensure the stability of our company for years to come. Thank you all for joining the call today. We look forward to speaking with you again in August.